Good morning, Southern California. I'm John Baldwin with John Hart Real Estate, and today is March 16th, 2022. Want to get into the Federal Reserve meeting. It met today, and there's a lot of news. So what the Fed did today is they raised the Fed funds rate by 25 basis points or 0.25%. One of the Fed chairmen, I believe the St. Louis one is what the article said, wanted to go a full 50 basis points or, let me center myself a little better. 50 basis points, but I guess he was overruled by the rest of the chairman. So I think they're trying not to be too aggressive. Now, if we remember the late 90s, they got super aggressive on interest rates and did a ton of interest rate hikes and slammed the brakes on the economy. And it caused this like herky-jerky motion to the economy. So I'm hoping that they do, learn their lesson from that and do not get too aggressive. But what we're seeing here, I'm going to jump into the CNBC article. So this is from CNBC.com. Federal Reserve approves the first rate hike in more than 3 years. So the last rate hike was December of 2018. And then they see 6 more ahead. So that is 7 for 2022. And then further down in the article, they mentioned 3 more in 2023 and none in 2024. So what does this mean? As I mentioned in my video the other day, this is going to increase your credit card payments. It'll eventually increase some of the bank products like auto loans and deposit and your deposit interest rate. But banks are much slower to react to this kind of thing, so it's a little more baked into everything already. So the bank products are slower to move on that. And then mortgage rates usually try to factor in ahead of time because with mortgages, they're usually originating the mortgage 30 days out. So they're trying to anticipate what happens in the future. So they try to bake in some of this, but they're going to have to work through this and see how that plays out. But we're definitely going to have some volatility in the mortgage industry. So let's get into this article a little bit and see what they're saying. But this is definitely an article worth reading. It's CNBC.com from today at 2 p.m. Eastern. So if you want to check that out. So they're going to try to get aggressive because they know. Now, there's a chart that I've pointed to, and I know a lot of people point to, and you may not be aware of it. It's the chart is called the M1 money supply. And pretty much throughout the last 100 years, the M1 money supply has been like almost a very flat line, just barely increasing through time. And then you had the 2008 financial crisis, and that angle went from barely above flat to a pretty good angle, and it just started increasing. And then, it kept increasing. And then at the beginning of the pandemic, they changed the rules around checking accounts and savings accounts. So what they did is they made it so that your savings account could function like a checking account, which brought all that money into the chart of the M1 money supply. So there became a vertical line. Now we can ignore the vertical line because before and after the vertical, the rate of increase had gone to like almost 60% and then afterwards to 70%. So check it out. We have grown our M1 money supply, our actual money supply, by something like $10 trillion over the last 2 years. So that is something to check out. You cannot print this much money without inflation coming down the pipe. So my easiest explanation of how to understand inflation is like with fractions. So we all know that 1 out of 10 is 10%, 1 out of 100 is 1%. Now, when we take the 1 and we have the 100 and we expand the bottom, the denominator, but we don't touch the numerator, we're basically inflating. That's the concept. Basically, so your 1 out of X is now 1 out of X plus 10 million. It's no longer the 1 out of 100, it's 1 out of 1 million, 1 out of 10 million. You are shrinking the size of that one, so you're now going to need more of those ones to make up the whole, if that makes sense. So I think fractions are the easiest way to understand inflation. We are increasing the denominator and not touching the numerator. So it becomes, instead of 1 out of 100, it's now 1 out of 10 million. Again, so kind of explain it to me like I'm 5 version of inflation, but I'm hoping you understand. So they're also lowering their expectations for economic growth. Okay, and sharply raise their outlook for inflation. So this is something we're going to have to look at, keep an eye on. Now, it sounds like we're basically going to be getting 10 rate increases, the one from today and 9 more, and they're going to keep ramping it up. Now, they could be 25 basis point increases, they could be 50-point basis increases. I'm hoping they're all 25-point basis increases, because if we start going bigger and bigger chunks, we're not talking about 2.5% altogether, we're talking about more. So it's just something we got to see what the Fed is thinking, because in theory, their number one job is to head off inflation. And I'm a bit more of a Milton Friedman acolyte or a Thomas Sowell acolyte, where I think the Fed's job is basically to grow the money supply at a constant rate through time and not try to play around with it, because when you play around with it, you start manipulating things, you get unintended consequences, and you create bubbles. There's an old joke about the Alan Greenspan put, because he would start playing around with rates, and you can see what sectors of the economy he was trying to create a bubble in. So that's just one thing. I'm not a fan of a very proactive Fed. I wish they would be a little more just grow the money supply at a constant rate through time. You have one job, and that's inflation. They shouldn't be considering, oh, if we do this, we can fix this over here. No. Your job is the money supply. That's it. But I said, I'm more of a Thomas Sowell, Milton Friedman, Austrian school, economics kind of person. So, but yeah, if you haven't read Thomas Sowell, you need to. The guy is freaking brilliant. There's a bunch of stuff on YouTube as well. So check out Thomas Sowell. I'm a big fan, and I frankly think Thomas Sowell is one of the greatest thinkers of the last 100 years. So definitely somebody worth checking out if you haven't read Thomas Sowell yet. Started out as a radical Marxist, and now he is everything but a radical Marxist. So a really interesting guy, and definitely worth reading. So check out Thomas Sowell. Another one, Walter E. Williams. He just passed away a couple years ago, which was just tragic, but he was also one of my favorite political economists. Just super smart dude. All right, sorry. Little sidetrack there. But I want to jump in and see how this has affected things. So this is all, there was one dissent who wanted a higher increase. Yeah, so, and as you can see, there's a chart right here. This is what Fed funds rate back in the day. This is what I was mentioning. My aunt and uncle back in 1980, 81 got their first mortgage. The Fed's funds rate was 19%. And I think they said that their mortgage was something like 21% back in the day. So, that's, and here we are now. Again, we are at record lows right now for interest rate. Now we're above, like we were at like 2.5%. We're now right around 4%, which is still very low on the great, the scale of mortgage rates. So, something to take into account. So. Okay, and then this is something I mentioned the other day in another video. They are anticipating starting to try to shrink the Federal Reserve balance sheet sometime in the summer, but they didn't mention. Here we are. Fed Chairman Jerome Powell did not specify when the balance sheet rundown will start, but he said the process could be equivalent of another rate hike this year. So. When they stop buying mortgage-backed securities and stop being that sort of thing, help it keep mortgage rates down, we could see more increases if they stop buying mortgage. Now we know that they're going to stop the quantitative easing, which is increasing their balance sheet. Now we are going to have to wait and watch and see until they start shrinking the balance sheet, because what they're doing right now is they're just going to be maintaining. So they're not going to completely stop mortgage backs. What they're going to do is they're going to stop buying, expanding their balance sheet. So anytime one drops off, they'll replace it effectively. So this is just stuff to watch. We got to keep an eye on things, because I think if they get too scared and they slam on the brakes too hard, that is worse, because then they can really cause they could hamper economic growth, which we need the growth to fix this mess. So, but let's jump into what's going on. This is the stock market from today. So it erased, once that was announced, it erased 500 points of gain, and then it is settled somewhere around, I think they said 70 points. We're now at 108 points right now. So that's something. But yeah, Dow gives up 500-point gain after Fed raises rates and signals 6 more hikes coming this year. So all good data. Check out these articles on CNBC.com. And if you have any questions, give me a call, 213-973-3777. I think this is all important data for people to have when you're looking and shopping for a house, because you need to be paying attention. Now, typically, when the stock market has a bad day and loses ground, doesn't just have a volatile day, but loses ground, we have a great day in the mortgage-backed market. So anytime the stock market drops, we see a lot of that money go into the mortgage-backed security market, improving rates. So keep an eye on rates. Talk to your lender. If you don't have a lender, give me a call, 213-973-3777. I'll hook you up with one of my fantastic lenders. And then when the right house pops up, we're going to get you into it, and we're gonna make sure you live in your dream house. So give me a call, and let's get your house sold.